let's. I pulled up the 10-year U.S. Treasury bond yield, and you can see how it was like growing slowly initially, right about through here, but then it whipsawed really fast up. It caught everybody by surprise, and this is where we felt a lot of pain right about here, to be honest, in the financial markets, specifically the growth stocks, especially the more extended valuation growth stocks, and my portfolio, like many others, really took a little bit of a hit, and it kept really getting worse and worse as many of us were experiencing. But I never believed in the permanent inflation story. We've had over a decade of inflation undershooting the 2% Federal Reserve goal and what most global economies goal of 2% inflation in the economy. We just didn't have that experience, and my opinion of that has always been that technology is deflationary, and that has increased productivity and reduced the number of labor hours needed, and increased the amount of production that can be done for the number of labor hours when combined with fixed capital and other capital investments. And really, technology has been amazing in terms of reducing the cost to consumers and helping consumers being able to buy more stuff at a cheaper cost, and that's all real GDP growth. And so, however, it is deflationary, and under 2% is not the ideal, at least what economists claim. But in any case, we saw that I never bought into that argument that we're going to have persistently higher inflation. So as we were rocketing up here, and my portfolio and many others were dropping, I was buying. I bought pretty heavy around here, expecting, with as the interest rate was dropping, I was buying into this, and I bought fairly heavy at that point in time. I did not think that it would go down. I thought this was a normalization, so I bought pretty heavy here, but what I realized was right about here, and I was expecting the month-to-month inflation to go down, so I was looking at the CPI data being reported and the PMI data, and I noticed that at this point in time was really when the CPI second derivative, the change on the change, so to speak, had turned negative, and CPI was no longer accelerating higher. It was actually decelerating higher. And that second derivative meant that we're actually going to top out in terms of the inflation, so long as this trend continues, where that second derivative is actually going even more negative. And month to month, we noticed that CPI and PMI data is actually decreasing. And so this was the moment. The bulls started fighting back here, increasing the price on the yield. And I disagreed with this, but you see the triple top, 1, 2, 3. That really indicates that now that it's a reversal going down, that we have a bear market in yields, or bull market in the bond prices. So it's great for tech, great for growthier stocks. And the PMI releasing today, really right at the time that the technical shows that if it breaks through this lower channel trend line, you're going to get a fall. And where will it fall to? Right about here. So, this is about, what am I reading, 11.97, so that's 1.19 or 1.2 on the Treasury rate that we can expect. I would not be surprised by September that this could really go down that far, and you're going to see the market pick up on the growthier side of things at that point in time. We'll see how the Federal Reserve's tapering that might come around the Jackson Hole meeting this year in, I think it's August or September. Yeah, I think it's August. That it's going to actually cause how it's going to change the Treasury rates. I think it's pricing it in. I think we're going to see this go down to 1.2, and that's interesting. You would think tapering is actually going to yield higher interest rates, but like we talked earlier, where a lot of those global countries, global investors don't have yield, they're just buying this up. So this is going to go down. Hope this helps. Let me know. Give me a thumbs up, subscribe if this is helpful for you, comment on what you think.